Hi guys, this is day 17 of the A2 Economics Revision Challenge, and today we are doing monetary policy. When we look at monetary policy is an attempt by the government or the central bank to manipulate monetary variables such as interest rates and money supply to achieve policy goals. What are our four policy goals? Well, we say four policy goals include price stability, low unemployment, high economic growth, and balance of payment. So what we'll see first is how changes in, for example, money supply can make us achieve our policy goals. So the first policy goal that I'm going to discuss is basically what we call price stability or keeping inflation low. In order to achieve low inflation through our monetary policy, we use what we call contractionary monetary policy. And that contractionary monetary policy's goal is to make sure AD falls. How do we achieve that? Well, we simply reduce money supply, which causes our interest rate to go up. And this increase in interest rate results in two things. Number one, consumption and investment will fall because our cost of borrowing is going up and incentive to save is going up, which causes basically AD to go down. And number two, because interest rates are going up, there's also a possibility of hot money or short-term financial flows, hot money to flow in, which causes exchange rate to go up, and therefore exports become expensive, imports become cheaper, and X minus M falls, which causes again AD to fall. So when you are looking at contractionary monetary policy, you are looking at AD to fall, and that fall in AD causes our demand for inflation to be kept under control. So the diagram that I'm going to make here to show this would be, the first one will be your money supply and money demand. So this is my liquidity preference curve, LP naught, and let's say currently money supply is MS naught. I will reduce my money supply from MS naught to MS1, which causes our interest rate to fall, interest rate to rise, and that rise in interest rate would mean our AD curve, if this was my AD before and AS before and therefore price level before, my AD curve will shift backward to AD1. And this fall in AD basically results in the price level to fall and the country will have a lower demand for inflation. So this is where the monetary policy at work, where the rise in interest rate causes our AD to fall because of both consumption and investment are falling, as well as your X minus M goes down, causes AD curve to shift backward. Now let's look at our second goal. What if we want to achieve what we call balance of payment equilibrium? So in case of balance of payment equilibrium, let's say if your current account is in a deficit, then we say this: whenever your current account is in a deficit, we normally can do two kinds of policy. One is we could basically simply use monetary policy to make what we call expenditure dampening policy. So the expenditure dampening policy argument is simply, if your country is such that your AD is very strong, and if this AD is rising, which causes income to rise and people to spend more on import, we do what we call expenditure dampening policy, which results in AD to fall, which causes GDP to fall, and in turn, because GDP fall, people will buy less imports, import expenditure goes down, and therefore X minus M goes up. So this policy simply requires to what we do. It's the same kind of policy that we did earlier, which is what we call contractionary monetary policy. When you do contractionary monetary policy, you make the AD fall, and when you make the AD fall, people who have a tendency to buy foreign goods because their incomes are going up will spend less on foreign goods, and therefore Expansionary goes up. Now, there are many downsides of this policy, but we can talk about it later. But this is what we call expenditure dampening policy, which is basically contractionary fiscal and monetary policy, where contractionary monetary policy will require using money supply to go down, causing interest rate to go up, and therefore AD to fall, and therefore Expansionary to rise as imports go down. Next goal is basically, after current account deficit, we want to talk about how do we increase GDP or economic growth. Our economic growth could be actual versus potential. This is, we are looking at economic growth which is actual in nature, which is simply AD to rise. If you want the AD to rise, we know this, we can do what we call expansionary monetary policy. When you do expansionary monetary policy, we are trying to basically make the money supply go up, which causes interest rate to fall, and that will result in consumption to fall, in consumption to rise, because interest rate is going down means cost of borrowing is going down, incentive to save is going down. So consumption goes up, investment goes up, and therefore AD goes up. Also, because interest rates are going down, we know this, that hot money flows out, causing exchange rate to fall, and therefore Expansionary to go up. When the exchange rate goes down, the reason why Expansionary goes up is simply because exports become cheaper, imports become expensive, and therefore Expansionary goes up, which again causes AD to go up. So we use what we call expansionary monetary policy when we want to achieve basically economic growth, and in that case our AD curve will be shifting to the right. So our AD curve will look something like this, which will shift to the right as we are trying to achieve economic growth. So let me draw that graph here, where expansionary monetary policy is trying to achieve more economic growth or actual economic growth through this goal. So GDP goes up. I have real GDP here on my x-axis and my price level here. Of course there will be inflation, but of course we are trying to achieve what we call actual economic growth and not worrying about inflation. So AD goes up, GDP goes up, and we achieve what we call our actual economic growth. Now this also means our fourth goal can also be achieved through that, which is basically lower unemployment. If you want to achieve lower unemployment, you can see this from the diagram, that when your AD goes up, you could have GDP to rise, which can result in unemployment to fall. And that's exactly what we can get through what we call expansionary monetary policy again. So when you want to achieve economic growth and lower unemployment, you do expansionary monetary policy. While the first two goals, which was balance of payment as well as inflation, we may do what we call contractionary policy, which means also that there is a conflict of interest as well, which is basically the first two goals of economic growth, the first two goals of price stability and balance of payment are definitely in conflict with unemployment and economic growth. So that's the trade-off an economy faces. But this is how we use monetary policy to achieve our economic goals. Let's now look at some of the limitations of the monetary policy. Well, the first limitation of monetary policy that we would like to discuss is about the demand for money. According to the Keynesians, the demand for money is very elastic. They draw a curve like this, where the demand for money or the liquidity preference curve is very, very elastic, in fact perfectly elastic. So if this is a curve, then what they argue is that if there is a rise in money supply from MS0 to MS1, then you may not see, for example, interest rate to change. And that's what they call liquidity trap. The idea that we discussed in the last video as well, that if the demand for money is very elastic, in fact perfectly elastic, then any rise in money supply will result in interest rate to not change. And if interest rate is not changing, then basically we will not see any of the economic variables to change. So the idea goes this: once people believe that the rate of interest will not go any lower, they will basically keep on holding more money balances, or that's what we call liquidity trap. And as a result of this, monetary policy will become completely ineffective in making the aggregate demand of the economy to change. Hence, according to the Keynesians, liquidity preference curve is ineffective because when the interest rates are really low, there will be what we call a possibility of liquidity trap to take place in the economy, where a rise in money supply only results in people to hold more money balances than to spend them and make the AD go up. The second important criticism when it comes to the demand for money is the idea about interest rates and investment. The whole idea is just that Keynesians say demand for investments is something like this, a very, very elastic curve. So this is my investment, this is my interest rate on my y-axis, and I have quantity or of investment or planned investment. So they say this, that even though your interest rate may go sort of down by much from R0 to R1, you may not see the total quantity of investment to go up, because people or businesses are much more likely to be affected by other factors like state of the market, the business confidence and consumer confidence, rather than interest rates. So Keynesians argue that investment is unresponsive to change in interest rates. So even though your interest rate may fall, people will not consume more, firms will not invest more, because other factors are more important, like consumer and business confidence. The third sort of downside or criticism to what we call our monetary policy is to do with time lags. So the whole idea is this, that when we increase money supply, our interest rate will fall. That causes C to change and I to change. So for example, C goes up and I go up. But according to the Keynesians and many other economists, there is what we call a time lag, a delay that happens. So when interest rate goes down, people do not immediately cut their savings. And if that's the case, if they do not respond quickly to changes in interest rate, then there will be a lot longer before consumption pattern changes. And if consumption pattern takes much longer, then only firms will react by changing output, which means it can take much longer for the AD to change. Last important thing is the mobility of financial capital. The whole idea goes this, that with increasing mobility of financial capital, sometimes becomes very difficult for economies to change interest rate that often. So let's say if they decide to lower interest rate, they notice that hot money will flow out, and that could cause the Expansionary to go up. But what if you increase interest rate? This means that money flows in, and that can cause a current account deficit in the balance of payments. So sometimes, in order to make sure our trade position doesn't change, we do not change interest rate too much. And lastly, an important thing that we need to understand this is that in a flexible exchange rate regime, we still use monetary policy, but in a fixed exchange rate regime, monetary policy is limited in use, because in a fixed exchange rate, interest rates are normally used to manage exchange rate, which means it can't be used for any other policy. So these are the few of the limitations that we can talk about in a monetary policy.